Here I am taking live classes on GST and income tax. So I welcome you on this YouTube channel. If you use the referral code CSATB, then you can also join unacademy.com/plus website. Here goal has to be chosen as CA exam, and then you can subscribe. You can refer to your relatives or friend who are preparing for CA exam or for CS exam, cost accounting, or are doing graduations and preparing for BCom exam. Then all of them can join unacademy.com/plus website. For 1 month you can try for 499 rupees only. There are various benefits of joining this class. You can learn from your favorite teacher. You can participate in doubt session and can ask your doubt. With single subscription you can have unlimited access of costing, accounting, auditing. Unlimited live classes are there on the best education platform in India, that is the unacademy.com. Real-time interaction with the teacher you can have. You can ask doubts in live class and clear your doubts. You can also download the videos and watch offline. So even if a class is missed by you, then later on you can watch the recording. You can participate in weekly quiz, mega quiz, and there are many more things which will be beneficial for you if you will take Unacademy Plus subscription. If you will use referral code CSATB, then you can also get 10% discount. So here goal you have to choose a CA exam on unacademy.com/plus website. So friend, let's start today's topic, that is income tax practice session with multiple choice questions. If you have any doubt regarding any question, then you can go on my profile unacademy.com and can comment. You can search Satbir Singh profile on unacademy.com and can comment under discussion form. If you are seeing the recording of this lecture, and the rule of these lectures are that you should try to answer this question on your screen. If you have a pen and a copy with you, then you should note down the answer that you are giving, and then you should match the correct answer, which we will discuss later on. So at the end of the session you will be able to know whether you have answered the question correctly or you need to prepare for your exam. If any topic is not, if you have not answered any topic correctly, then you can prepare. You can also join my GST class on unacademy.com, GST revision class from 12 to 1 p.m. in the afternoon, and income tax class from 6 p.m. to 8 p.m. in the evening on unacademy.com/plus website. So income of a trade or professional association from specific service performed for its members shall be exempt, taxable under the head business and profession, taxable under the head income from other sources, or none of the above. So you note down the correct and answer, and I am going to discuss the correct answer. You can pause this video and replay it again. So correct answer is B, taxable under the head business and professions. Even if a trade or professional association receive amount from their members and perform certain services, then it's taxable under the head business and profession. Income under the head business and profession. Second question, under the head profit and gains of business and profession, the method of accounting that should be followed by an assessee is the cash system only, mercantile system only, hybrid system only, cash system or mercantile system only. So under the profit and gains of business and professions, there are the methods which are allowed by the income tax department. So once the method is followed by the assessee, it has to be regularly followed by the assessee. So you decide the correct answer. I am going to discuss. You can pause this recording and replay it again. Correct answer is D, that is cash system or mercantile system of accounting. Cash system is suppose a doctor receives fees from its parents, from its patients, then the amount received would be taxable under the head from business and profession, and the amount received is taxable on cash system, because the doctor is recording the fees whenever it is received. The fees that is due is not recorded by him, but a businessman record his sale based on credit. Even if the amount is not realized, then even then it is treated as sales. So he is following the mercantile system of accounting. So in mercantile system, all revenues and expenses are recorded on accrual basis, because they are due. Suppose rent of the building is due but is not paid, then the entry is made in books of account and expenses claimed in the books of account. But in cash systems, rent will be recorded when it is paid. It is not recorded on accrual basis. So whatever method the assessee follow, it has to follow regularly. It cannot follow cash system for 1 year and the mercantile system for another year, and then cash system for again 1 year. So it have whatever method it adopt, it has to follow continuously, and according to that the income of a person is calculated under the Income Tax Act under the head business and profession. So method of accounting is relevant for two head. First is business and profession, second is income from other sources. But it is not relevant for the salaries, house property or capital gains. Suppose a person had rendered the services but he has not received the salaries. Salary is due. He cannot say that he has not maintained books of account and he has not received salary, so he will not pay income tax. He has to pay income tax, because the rule of salary are whether due or received, whichever is earlier, the income tax has to be paid on the salary. Similarly, the case with the house property and the capital gain. If the property is transferred, even though you have not deposited the check into the bank, but since the property has been transferred, so you have to calculate your capital gain and has to pay income tax. So method of accounting is not relevant for income under that salaries, income under that capital gains and house property, but it is relevant for profit and gains from business and profession and income from other sources. B gifted the house property to his minor son, which was let out at the rate of 9,000 per month. Income from such house property shall be taxable in the hands of minor son B. However, it shall be first computed as minor income and thereafter clubbed in the income of Mr. B. B, as he will be deemed he will be the deemed owner of such house property and liable to tax on none of the above. There is a complete chapter on clubbing and house property that I have covered and is available on unacademy.com. Under my profile says Satbir Singh, complete course on income tax. In that course I have covered in detail multiple choice questions, practical examples and the cases where the income from house property is taxable and clubbing provision will apply. So you decide correct answer and then you can move forward. In the meanwhile, you can pause this recording and play again once you have decided the correct answer. So here the correct answer is C. That is, Mr. B as will be deemed owner of the house property and liable to tax. So here we have referred section 27 of the Income Tax Act, which says that the deemed owner of the property is the transferor, that is the person who has transferred the property. It will not be the transferee. Suppose a father transfers property to his minor son so that he can reduce his income tax and he thinks that by transferring the property rental income will be treated in the minor son, but it is not the case, because the Income Tax Act says that if the transfer the property, then the income will be treated in the hands of the transferor, that is the person who transfer the property, and not in the hands of the person who receives the property. So in this case, Mr. B will be deemed owner of the property, so rental income will be taxed in the hands of Mr. B. Similarly, if the husband transfer the property to his spouse or wife transfer the property to his husband, so in that case wife transfer the property to her husband, and in that case also wife will be treated as the deemed owner of the property, that is the person who has transferred the property without consideration, so it will be treated deemed owner. Otherwise, the clubbing provision will apply for other assets. Suppose a person's transfer is fixed deposit to his wife's names, then the income from the FD will be treated in the hands of husband and not in the hands of wife. So here correct answer was B. What are the conditions to be fulfilled in order to claim exemption of unrealized rent under that income from house property? The defaulting tenant is in occupation of any other property of the assessee. Steps have been taken to compel him to vacate the property. The tenancy is bona fide, both B and C. So income under the house property, I have taken a complete lecture which is available on my profile CS Satbir Singh on unacademy.com. You can refer to that chapter. Here correct answer is D, that is both B and C. Defaulting tenant should not be in the occupation of any other property of the assessee. Only then unrealized rent can be deducted. Second one is that steps should have been taken to compel the tenant to vacate the property. So you should have filed a case in a court so that unrealized rent can be deducted, and you are not required to pay income tax on the unrealized rent. If you have not taken these steps, then you will be required to pay income tax. Mr. B, a chartered accountant, is employed with A Limited as an internal auditor and requests the employer to call the remuneration as internal audit fees. It shall be chargeable to tax for such fees under the head income from salaries, profit and gains from business and profession, income from other sources, none of the above. Which one is the correct answer? So here correct answer is A, that is income from salary. It will not matter that the amount is called as an internal audit fees or any other nomenclature will not change the nature of the income, because Mr. B's chartered accountant is implied by A Limited, and under the head salaries, if there are the employer and employee relationship, then the income is taxed under the head salaries. But if there are not employer and employee relationship, then it is not taxed under that salary. Suppose a doctor is hired by a hospital, and he comes and do the operation of the patients and then goes from the hospital, then his income is not taxable under the salary, because he is not working under the direct supervision of the hospital. He is working independently. But here the person is working under the supervision of the employer. He will guide him how the work has to be done. So it's a contract and contract for employment. So the income will be taxable under their salaries. But in case of the professional services, the person works on his own. He's not working under the supervision of any other person. So the income in case of professional, taxed under that income from business and profession. Maximum exemption limit in case of employees covered under Gratuity Payment Act is rupees 2 lakh, rupees 3 lakh, rupees 5 lakh, rupees 20 lakh. So I have taken a complete lecture on income under that salaries, which is available on unacademy.com/plus website. You can refer to that course under my profile CS Satbir Singh. So here correct answer is rupees 20 lakh. The government has fixed the maximum exemption limit in case gratuity is paid to the employees as 20 lakh. Earlier it was 10 lakh, but then it was increased by the government to 20 lakh. Whether open land would be charged under income from house property, is it true or false? Suppose Mr. A has received a rental income from a land or a vacant plot, then whether it will be charged under income from house property or from under any other head. Here correct answer is B, that is the statement is false, because in income under the house property we will charge income received from building or land appertaining thereto of which assessee is the owner. Once plot of land is charged either under the head income from other sources or business income, as the case may be. So open plot of land is charged under that income from other sources or business income, because it depends upon the business that the person is doing. If he is regularly doing this business of renting out a plot of land, then it could be under that business income. If it's a one-time transaction, then it could be under that income from other sources. Where the property is acquired or constructed with the capital borrowed on or after 1st April 1999 and such acquisition or construction is completed within 5 years, how much deduction is available for self-occupied property? Rupees 2 lakh or rupees 30,000. So here the capital is acquired or constructed with capital borrowed on or after 1999. And the property is declared as self-occupied property under the Income Tax Act. So how much deduction can be claimed for this loan and interest payable? Here the correct answer is A, that is for getting deduction of interest of maximum of rupees 2 lakh. It will be necessary to obtain a certificate from the person to whom such interest is payable, specifying the amount of interest payable by the assessee for the purpose of acquisition, construction of the property, or conversion of whole or any part of the capital borrowed, which remain to be repaid as a new loan. So when the property is acquired or constructed and is self-occupied, then up to a maximum of rupees 2 lakh you can claim a loss under the head income from house property, because income from self-occupied property treated as nil. So for acquisition construction, the limit is 2 lakh. If it is for other purpose like for repair, renovation, renewal, etc., then the deduction of rupees 30,000 of interest payable is can be claimed. Here the interest is not required to be paid, it's on payable basis. Suppose the interest is due but you have not paid the interest to the bank, then still you can claim the deduction. But in this case you have to give a certificate. You have to take a certificate from the person from whom you have borrowed the amount that the interest is payable to him. Next question, deduction under section 24B of the income tax is available on account of municipal taxes paid by the owner, capital expenditure incurred by the owner, revenue expenditure incurred by the owner, interest on capital borrowed for the purpose of purchase, construction, repair, renewal, or reconstruction of the property. There are two important deductions under the head income from house property. One is under section 24 subclause A, another is section 24 subclause B. So friends, here correct answer is D, that is deduction under section 24 subclause B is available on account of interest on capital borrowed for the purpose of purchase, construction, repair, renewal, or reconstruction of the property. So it's a deduction that is available. So next question, the annual value of the property consisting of any dash of which the assessee is the owner other than such portion of the property as he may occupy for the purpose of any business or profession carried on by him, the profit of which are chargeable to income tax shall be chargeable to income tax under the head income from house property, building or land appertaining thereto, buildings, land, residential building. Which one is the correct answer? So here the correct answer is building or land appertaining thereto is chargeable to income tax under that income from house property. Suppose there is a vacant plot of land which is given on rent, then that is not chargeable under that income from house property, because that is not a building. There should be a building and there may be land appertaining thereto. Suppose there is a big house and in front of that house there is a garden also, and for building and garden complete rent is being paid, so the entire amount is taxable under that income from house property. So there should be a building. Suppose there is a plot of land and on and you have made boundary around this plot and you have given it on a rent, it's not taxable under that income from house property, because it's not a building. Characteristic of buildings are that there should be a walls and roof it extra, so there is no wall and roof, so it cannot be called as a building. So there should be a building. Apart from building there may be a land which is attached to that building, So the entire amount received will be taxable under that income from house property. But if there is no building, then it cannot be said that the income will be charged to tax under the head income from house property. But if the person uses this building for his own business or profession, then it is not chargeable to tax under that income from house property. Mr. Ram owns a flat which is rented by him at a monthly rent of rupees 84,000. Municipal taxes on the property levied by the local authority for the year amounted to rupees 4,000. Out of 4,000, Mr. Ram has paid rupees 3,000 in the current year, and balance of rupees 1,000 is paid in the next year. In this case, while computing the income from the house property for the next year, he will be entitled to claim deduction or count of municipal tax of rupees 4,000, 3,000 or 1,000 or nil. So which one is the correct answer? Out of 4,000, he has paid only 3,000 on municipal tax, and balance amount is paid in next year. How much municipal tax can be deducted by Mr. Ram from rental income? So you can take more time by pausing this recording. I am going to discuss the correct answer. Here correct answer is C, that is while computing the income from house property, assessee can claim deduction on account of municipal taxes paid by him during the year. In this case, out of rupees 4,000, rupees 3,000 is paid by Mr. Ram in the current year, and balance rupees 1,000 is paid in the next year. Hence, in the current year, he can claim deduction of rupees 3,000, and in the next year, he can claim deduction of rupees 1,000. So next question, following information is provided by Mr. Ram in respect of a property rented by him. Gross annual value of rupees 2,84,000. Municipal taxes for the year paid by the tenant paid during the year rupees 10,000. Electricity bill of the property paid by Mr. Ram paid during the year rupees 12,000. What will be the net annual value of the property? Rupees 2,84,000, rupees 2,74,000, rupees 2,62,000 or rupees 2,72,000. So I had taken a complete lecture on income under the head house property. We had discussed the concept in detail, multiple choice question, practical examples. All are available on unacademy.com/plus website. So you can take a paid subscription and can refer to those concept, multiple choice questions and practical examples. Here correct answer is A. The remaining amount left after deducting the municipal tax from the gross annual value is called net annual value. In this case, municipal taxes are paid by the tenant. Hence, Mr. Ram cannot claim the deduction account of municipal tax. Only that amount can be claimed by deduction which is paid by the owner of the property. So here the owner of the property has not paid the municipal taxes, so he cannot claim the deduction. Therefore, the gross annual value will become the net annual value, and thus no deduction will be available for the municipal tax. Similarly, the electricity bill of the property are not deductible because there is a standard deduction under section 24 subsection 1, which is 30% of the net annual value that's given by the government for the various expenses that the person may incur, like repair, maintenance, electricity bill, etc. So no other deduction is allowed from the gross annual value apart from municipal tax. So only municipal taxes paid during the year are deductible. Following information is provided by Mr. Ram in respect of a vacant plot of land rented by him. Annual rent rupees 4,84,000. Municipal tax paid during the year rupees 10,000. No expenditure is incurred by Mr. Ram in relation to above property. In this case, what will be the amount of deduction under section 24A, which can be claimed by Mr. Ram while computing the income from above house property? Nil. Rupees 2,65,200, rupees 2,95,200 or 30,000. So here the correct answer is A, that is nil, because here what's given is a vacant plot of land. You are taking rent for vacant plot of land, and plot of land is not taxable under that income from house property. So the rule of income from house property will not apply to this income, because once you will determine whether income is taxable under the income tax act or not, and then you will decide under which head it is taxable. If it is taxable under the salary, then the rule of salary will apply. If it is taxable under that house property, then only the rule of house property will apply. Here the income is not taxable under that house property, therefore the rule of house property will not apply to the vacant plot of land. Mr. Ram and Mr. Raj are the co-owners of a bungalow, 50% share each. The bungalow is given on rent to a company at a monthly rent of rupees 25,200. Bungalow is acquired by a bank loan, and loan is sanctioned in the name of both the co-owners. Both the co-owners are paying the installments by sharing the installments equally. Total interest for the year amounted to rupees 2 lakh. In this case, Mr. Ram can claim deduction under section 24B of rupees how much, and Mr. Raj can claim deduction under section 24B of rupees how much? 1 lakh and 1 lakh, 1 lakh and nil, nil and rupees 1 lakh, nil and nil. So here the correct answer is A, that is both the owners have borrowed the fund and are paying the interest, hence deduction on account of interest will be equally distributed between them. Deduction of rupees 1 lakh will be available to each co-owner, thus option A giving the correct amount of deduction. Therefore, once the amount is borrowed by the co-owners of the property, then the amount of the interest amount payable on loan will be equally divided by the co-owners if they are the equal, if they have a equal share in the property, like in this case 50% share both the co-owners have. So, and loan is also borrowed by both of them, so amount of rupees 2 lakh, 50% deduction will be claimed by Mr. Ram of rupees 1 lakh, and 50% deduction will be claimed by Mr. Raj of rupees 1 lakh from this interest payable amount. Mr. X has applied for purchasing a flat in a new colony in Gurgaon. Loan has also been sanctioned to him for his property. He has started making payment of the EMI, equated monthly installments. The possession of the property will be ready by July 2020. Whether he will be able to claim deduction in respect of the interest paid by him for this property, true or false? Here the correct answer is false. Mr. X will not get any deduction in respect of the interest paid by him. This is mainly because of the fact that the house property yet not ready. The deduction in respect of the interest will be allowed only when the house property is ready for use. So once the property is ready for use, then only deduction for the interest payable on the loan is allowed, because the pre-construction period is interest is allowed in the year in which the property is constructed or is purchased. So it's allowed 1/5 equally in the year in which the property is constructed and in the coming years. So 1/5 amount of the pre-construction period interest is allowed once the property is constructed. When composite rent includes rent of building and rent of other assets, and letting out of the building and letting out of other assets are non-separable, that is both the letting are composite and not separable, then entire rent is taxed under that income from house property. This statement true or false? Sometimes it happens that the building along with machinery has to be given on rent. Building cannot be given separately, machinery cannot be given separately for rent, so both of them has to be given and composite rent is received for that. So whether the income, that is the rental income, would be taxable under that income from house property. Here correct answer is B. When composite rent includes rent of the building and rent of other assets, and letting out of the building and letting out of the other assets are non-separable, both the lettings are composite and are non-separable. For example, letting out of the equipped theatre, the entire rent is taxed under the head profit and gains of business and profession or income from other sources. So it depends upon whether the person. So in case of a theater, you cannot rent out a building without a screen and without the basic infrastructure in the building. So entire amount has to be rented out, and it cannot be taxed under that income from house property. So it will be either treated under that profit and gain from business or profession or income from other sources, depending upon the nature of the business of the assessee. So you have to compute the income from house property of Mr. Vikram from the following information. Particulars are given: house 1 property, house 2 property, and house 3 property. House 1 is self-occupied, house 2 is self-occupied, house 3 is owned for business. House 1 property situated at Chennai, house 2 at Bangalore, and house 3 at Hyderabad. Municipal value of house 1 property 1 lakh, house 2 2 lakh, and house 3 3 lakh. Fair rental value of house 1 property 3 lakh and house 2 and house 3 property 2 lakh. Standard rent of house 1 property 2 lakh and house 2 2 lakh and house 3 2 lakh. Municipal tax are 15% for all the properties. Repair is 30,000 for house 1, house 2 80,000 rupees, and house 3 5,000 rupees. Ground rent is 10,000 for house 1 property, nil for house 2 property, and house 3 it's 5,000. Land revenue nil for the self-occupied property, self-occupied 10,000, and self-occupied house 2 property 10,000, and on business house 3 nil. Interest on loan for construction is 40,000, house 2 property 1 lakh, house 3 property 20,000. Loan was taken with the 98, 99, 2000, 2001, 98, 99. So you have to find out the correct answer. So you can take more time, and if you have a Excel sheet in front of you, then you can do the calculation in the Excel sheet and can arrive at the correct answer. So if you have a copy pen with you, then you can do your calculation. You can pause this recording and replay it again. So friends, if you any of you have any question, then you can ask me. I am available live. So, or if you are if you are seeing the recording of this lecture, then you can comment on unacademy.com under my profile Satbir Singh. You can search on the top of unacademy.com. So if you have any question, you can ask me. So I am going to discuss the correct answer. So we have discussed in the chapter income from house property, which is available on my profile Satbir Singh on unacademy.com. Properties used for business will not come under that income from house property, because that is not chargeable under that income from house property. So house number 3 we will ignore in this case completely, because it is used for the own business. Then we will concentrate on house 1 and house 2 property. Both of the properties are self-occupied for the purpose of your calculation. So house 1 is we will take house 1 as self-occupied property and house 2 as deemed to be let out property, because till financial year 18-19 you can take only one house property as self-occupied, and then one property was then if the person is having more than one property, then the other properties are deemed to be let out. But from the financial year 1920 you can take 2 house property as self-occupied, and if you have more than 2 house property, then these are treated as deemed to be let out. So house property 3 is completely ignored. House 1 is treated as option 1, taking house 1 as self-occupied and house 2 as deemed to be let out. Option 2, take house 1 as deemed to be let out and house 2 as self-occupied. Since the annual value of both the self-occupied properties are competing with each other, therefore the total income under that income from house property will be computed, applying each option separately, and then the option which yield the least income under this head shall be opted. So here is a table which shows the calculation of the properties. I have taken the gross annual value of house property nil, and taking the house property deemed to be let out. So gross annual value of a house property 2 lakh, less municipal tax 15% of municipal value, which is 30,000. You will do, and net annual value is 1,70,000. 2 lakh minus 30,000, 1,70,000. Standard deduction 30% of net annual value, so 1,70,000 multiplied by 30%. It will come 51,000, and interest on loan is 30,000 available. But house to full amount of 1 lakh rupees is available. So you can see that out of 40,000 we have taken 30,000 amount, and out of rupees 1 lakh house property 2 loan we have taken complete amount as deductible. So total deduction in case of house and property 30,000 loss is there, and in case of house to property there is income from house property 19,000. So it's a calculation. And in option number 2 we have treated the house 2 as a self-occupied. In that case, whatever is the interest on loan, then it is deductible 1 lakh rupees. And in case of house and property deemed to be let out, then 2 lakh is the annual value, and then we will deduct the municipal tax of 15%, that is 15,000. The net amount will become 1,85,000. Standard deduction 30%, that is 55,500. And interest on loan is 40,000. So once we deduct this standard deduction interest on loan, the net income will become 95,000, 89,500. So 89,500 house 1 income, and house 2 loss is 1 lakh. So house 1 there is a loss. I'm going to correct this question. Here is a loss. So house 2 there is a loss, and house 1 there is an income. In option number 1, house 1 is a loss and house 2 is an income. So option 1 is better because yield least income or maximum loss. Therefore take house 1 as self-occupied and house 2 is deemed to be let out. So option 1 is better because here the loss is more. In house option number 2 loss is less. If you will deduct 1 lakh from 89,500, then there will be loss. But in option number 1 there is a more loss, so you will like to have more loss so that you are not required to pay income tax. So option 1 is better, so you should take option 1 here, because in option 1 there is a loss of 11,000 rupees. And option 2 there is a loss of 10,500. So you have to take house 1 as self-occupied and house 2 as deemed to be let out property. So next question, Star Public School Chennai is owned and maintained by XYZ Limited, a manufacturing company. Books of account of the school and XYZ are maintained separately. X is an employee of XYZ Limited. The following family members of X are the student in Star Public School. A, son of Mr. X. Cost of education in a similar institution 4,800 per month. Amount charged from X is 800 per month. B, dependent brother of X. 6,600 per month is the cost of education in similar institution, and amount charged from Mr. X is 1,600 per month. You have to find out the perquisites for the assessment in 1920. So you can take more time for the calculation. If you you can pause this recording and can replay it again. I am going to discuss correct answer. So here under the head income from house property, we have discussed the various allowance and perquisites. Complete lecture is available on my profile unacademy.com on /plus website, which you can which you can refer by if you are a paid subscriber of the website. So value of a free or concessional education perquisites provided by the employer, where education institution is owned and maintained by the employer. So there can be the two cases. It's if the education is provided to the children of the employee, second is provided to the other family member of the employee. If it is provided to other family member, then it is taxable perquisites. But if it is provided to the children of the employee, then cost or value of perquisites is less than 1,000 per month per child. then it's not a perquisite. If the cost or value of perquisite is more than 1000 per month per child, then it's a taxable perquisite. So you have to give a deduction of rupees 1000, plus if any other amount is recovered from the employee, then that you will reduce from the amount. Here Mr. A is the son of X, so that is X is the employee of the company. So in this case 1000 rupees will be deducted from this amount, because there is a deduction available for child 1000 rupees, and 800 rupees was recovered from the employee, that is 800 per month is recovered. So 800 is recovered and 1000 is allowed by the government. So balance amount for 12 months will be 36,000 per quizzes, and in case of Mr. B, who is the dependent brother of X, 1000 will not be deducted because it's available only for the children of Mr. X. Mr. B is a brother, so in this case nothing will be deducted, but 1600 cost recovered from the employee will be deducted. So you will multiply by 12 the figure 6600 minus 1600, and net amount will come 60,000 rupees. So it will be a taxable perquisites 96,000. 60,000 plus 36,000 will be a taxable amount. So if you have any doubt at any point of time, then you can comment on unacademy.com under my profile CS Satbir Singh. You can search CS Satbir Singh on unacademy.com, and you can comment there. Next question, Mr. Rahim, 55 years, has incurred the following expenses. Compute deduction available to Mr. Rahim under section 80D, that is the mediclaim deduction, mediclaim expenditure deduction. Mediclaim insurance premium paid for himself rupees 10,000. Mediclaim insurance premium paid for spouse 10,000. Mediclaim insurance premium paid for dependent children 5,000. Mediclaim insurance premium paid for mother 76 years 9,000. Mediclaim insurance premium paid for father 82 years 39,000. Preventive health checkup expenditure for father 6,000. Mediclaim expenditure incurred for father 14,000. So what is the correct amount? You should take your time to do the calculation. So you can pause this recording and you can do your calculation and then again check your answer. I am going to discuss correct answer. So here section 80D is the deductions factor of the medical insurance premium. First of all, payment for health insurance or medical health checkup is available to the individual. Payment of mediclaim insurance premium or contribution to the central government health scheme or any other notified health scheme. Preventive health checkup expenditure is available. Expenditure is that can be claimed is for himself, herself, spouse or the dependent children. Quantum of deduction lower of the following, that is the aggregate of the premium paid or the contribution made or preventive health checkup up to rupees 5,000 and 25,000 per annum, whichever is less. Suppose a person has paid health insurance premium for himself, herself, spouse or dependent children rupees 26,000, then the maximum deduction will be available for 25,000 only. Suppose the person has paid medical insurance premium of rupees 20,000, then the maximum deduction will be 20,000 only, because lower of the following 20,000 or 25,000. Suppose the person has paid medical insurance premium of rupees 25,000 plus 5,000 health checkup expenditure, so maximum will be 25,000 only. Suppose a person pays 10,000 as medical insurance premium plus 6,000 as preventive health checkup, he will be allowed only 15,000 rupees, because 1,000 will be ignored, because preventive health checkup can be incurred maximum to rupees 5,000. So second case, if the individual makes the payment of medical insurance premium for his parents, whether they are dependent on him or not, is available lower of the following, that is the aggregate of the premium paid or preventive health checkup or 25,000. But if the parents are senior citizen, then that is they are of age of 60 years or more at any point of time, then this 25,000 will become 50,000 and maximum deduction can be claimed up to 50,000 for parents. if the medical insurance premium is paid for them. Or preventive health checkup, it's available only up to rupees 5,000, but it is included in the aggregate limit of the premium paid plus preventive health checkup, that both of them should not exceed 25,000. If they are senior citizen, then maximum of rupees 50,000. There is a third case, that is if a Hindu undivided family makes the payment of Mediclaim insurance premium, then any member of the family expenditure incurred on behalf of any member of the family, then the lower of the following is available, that is 25,000 per month, or the premium paid, whichever is lower. Senior citizen, in case of a senior citizen, any member of the family of Hindu undivided family, then maximum of 50,000 can be claimed as a deduction, or the premium paid. Suppose the premium paid is 20,000 only, then the deduction will be 20,000. Suppose the premium paid is 60,000, in case of a senior citizen is also there, then maximum deduction is 50,000 only. Fourth case is there, which is about individual and Hindu undivided family, and this deduction is available if the Mediclaim insurance premium is not paid and medical expenditure is incurred. Sometimes it happens that the person doesn't take any Mediclaim insurance for the parents and medical expenditure is incurred. In this case, if the person is a senior citizen, individual, dependent children, or either of the parents, or in case of HN, any member of the family, then in that case medical expenditure incurred or 50,000 per annum, whichever less is allowed as a deduction. So here we will discuss the one by one. First of all, we will discuss the medical insurance premium paid by the person for himself, his spouse, and dependent children. So friends, we will take 1 minute's break only. So friends, Mediclaim insurance premium paid for himself 10,000, Mediclaim insurance paid for spouse 10,000, Mediclaim insurance premium paid for dependent children 5,000. So the total amount is 25,000. So maximum limit is also 25,000. So this amount is available. Second amount is you have to add in this amount of expenditure incurred for the parents. That is the Mediclaim insurance premium paid for the mother who is 76 years, that is a senior citizen, and Mediclaim insurance premium paid for father who is also senior citizen. Maximum amount paid is 48,000, but deduction allowed is 50,000. So up to 48,000 this expenditure is allowed. Third case is for preventive health checkup. Preventive health checkup expenditure for father is 50,000 minus B, because here already taken 48,000, so maximum is 50,000 available. Here the expenditure incurred is 6,000, but you will get a deduction of maximum rupees 2,000 only for this preventive health checkup, because the total expenditure in case of senior citizen cannot exceed 50,000. And another expenditure is also incurred for father being a super citizen, that is Mediclaim insurance premium paid on the health of the father. This expenditure will not be available because you have already claimed medical expenditure. Here you have claimed the medical insurance premium, so the medical expenditure will not be available, because if the medical insurance premium is paid, then medical expenditure deduction is not available. You can refer in our fourth slide. We have discussed this condition, that if the amount paid on account of medical expenditure, provided Mediclaim insurance is not paid on the health of such person. So here you cannot do both the things, that you can take medical insurance premium for your parents as well as you can take a deduction of medical expenditure. It's not allowed. You can take either of them. Either you take deduction for medical expenditure or you take deduction for medical insurance premium. So in this case, medical expenditure deduction will not be available, so it's nil. So this is the correct calculation. If you have any doubt at any point of time, then you can comment on unacademy.com on my profile Satbir Singh. Next question. Mr. A is a salaried employee who is working in a multinational company, Mr. A has taken accommodation or rent from Mr. B, who is non-resident in India during previous year 18-19 relevant to assessment year 19-20. Mr. A has paid monthly rent of rupees 75,000 per month to Mr. B. Mr. A is not having any income other than salary income. Determine whether Mr. A is under obligation to deduct TDS as per the provision of Income Tax Act 1961, and if yes, under which section. Not liable to deduct TDS as per Mr. A is individually not subject to tax audit for the immediately assessment year. Liable to deduct TDS under 194I, it's for rent. Liable to deduct TDS under 194IB. Liable to deduct TDS under section 195, that is for non-resident. So which one is the correct answer? I am going to discuss correct answer, so you can pause this recording, and if you need more time for calculation, and then replay again. Here correct answer is as per section 195 of the Income Tax Act. Any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest or any other sum chargeable under the provision of the act. Here it's not written that a company is only required to pay. If a person is an individual or a partnership firm, any person who is responsible for paying to a non-resident, then any sum chargeable under which is not chargeable under the salaries, then he has to deduct the TDS at the time of credit of the income to the account of the payee, or at the time of payment thereof in cash, or by issue of check, draft, or by any other mode whichever is earlier. Deduct the income tax at the rate in force. So here the correct answer is D, that is TDS has to be deducted under section 195 because the payment is made to a non-resident person. Here you can see that Mr. B is a non-resident Indian, so Mr. A, although he is a salaried employee, but he has to deduct the TDS from the payment made to Mr. A, made to Mr. B from the rent. If the assessee Mr. C has paid self-assessment tax and amount so paid falls short of the aggregate amount of tax, interest and fee for assessment year 1920, what would be the criteria for adjustment self-assessment tax paid by the assessee? So the self-assessment tax paid is less than the amount of tax, interest and fees due from the person. How this amount would be adjusted? Amount so paid shall be first adjusted toward the fees payable, if any, and then towards interest, and balance, if any, left toward tax payable. The amount so paid shall be first adjusted towards the tax payable, then towards interest, balance, if any, towards tax liable payable. The amount so paid shall be first adjusted towards interest payable, thereafter against tax payable, and the balance, if any, shall be towards fees payable. The amount so paid shall be first adjusted towards the interest payable, thereafter against fees payable, and the balance, if any, shall be towards tax payable. So you can pause this recording if you need more time. I am discussing correct answer. Here section 140A of the Income Tax Act set the rule for self-assessment tax, where the amount paid by the assessee under this subsection falls short of the aggregate of the tax, interest and fees as aforesaid. The amount so paid shall be first adjusted towards the fees payable, because there may be the fees that is required to be paid. Suppose you file your income tax return late, so late fees is applicable, so first it will be adjusted towards the late fees, and then it will be adjusted towards the interest payable, if any, under the provision of Income Tax Act. If the balance amount is left, then it will be adjusted towards the tax payable. So this is the order how the income tax paid will be adjusted. So in this case, correct answer is A. The amount so paid shall be first adjusted towards the fees payable, if any, then towards the interest payable, if any, left towards the tax payable. Next question. Mr. Ram has prepared his computation of total income and tax liability for assessment year 1920 relevant to previous year 18-19, and the tax payable is rupees 15,000. He has the prepaid taxes, that is TDS, amounting to rupees 5500, and the balance tax payable is 9500. He has appointed you as to advise him regarding the applicability of interest under the various provisions of the Income Tax Act. He wanted to file the return of income in July 2019. Interest under Section 234B is applicable. Interest under Section 234C is applicable. Interest under Section 234B and 234C is applicable, or none of the above. So I have discussed how to compute income tax under the provision of Income Tax Act, which is available on my profile Satbir Singh on unacademy.com. You can refer to that lecture if you need any assistance in doing this question. I have also covered a chapter on how to pay advance tax and when the provisions of advance tax are applicable. So you can also refer to that chapter. So here correct answer. Under the Income Tax Act, different types of interest are levied for various kinds of delay and default. There are provisions Section 234A, 234B and 234C for levying the interest. First one is delay in filing the return of income. If you will delay, then the interest is levied. Second, if non-payment or short payment of advance tax is there, then interest is levied. Third, if non-payment or short payment of the individual installment or installment of advance tax, then that is the deferment of advance tax you have deferred, then 234C interest is levied. Therefore, when you look at the advance tax provisions, then advance tax is liable to be paid in every case where the advance tax payable is 10,000 or more under Section 208 of the Income Tax Act. A resident senior citizen not having any income from business or profession is not liable to pay advance tax with effect from assessment year 13-14 onwards. From the assessment year 17-18, NSSC who opt for the presumptive taxation scheme under 44AD and 44ADA is required to pay advance tax related to such business. However, advance tax can be paid during the financial year immediately preceding the assessment year on or before the March 15. Therefore, if a person opts a presumptive taxation scheme, then he is required to pay only the advance tax only in one installment, and resident senior citizen is not required to pay any advance tax if he is not having any income from business and profession. And if you will look at the interest 234B, says that when the advance tax is payable and the person does not pay the advance tax, then interest will be calculated. Second condition is that if the advance tax paid is less than 90% of the assessed tax, suppose the assessed tax is 1 lakh, the person was required to pay at least 90% amount, that is 90,000 advance tax, but he pays only 50,000, then 234B interest is calculated on the shortfall. Here the amount which is liable for interest under Section 234B is the unpaid amount, that is shortfall in payment of advance tax. Assessed tax less advance tax paid is called amount of unpaid or short paid advance tax. Assessed tax means as per Section 143(1) and where a regular assessment is made, the tax on the total income as determined under regular assessment are reduced by the TDS, TCS, relief, deduction under Section 89, 90, 90 or 91. So you will reduce all this, then the amount of unpaid and short paid tax will arrive at. So here the tax liability in this case is 15,000. When you will reduce the TDS 5,500, then the net amount unpaid is 9,500, which is less than the 10,000 rupees. Because if the advance tax is amount is 10,000 or more, then the person is required to pay advance tax if the tax liability is more after deducting the TDS extra. Since advance tax is not payable, therefore the interest under Section 234B and 234C is also not payable in this case. Hence, in this case, the correct answer is D, that is none of the above. Because Mr. Ram is not required to pay advance tax, because net tax liability is less than 10,000. Once the advance tax is not payable, then 234B interest is also not applicable. 234C is also not applicable because that is for deferment of advance tax. Once the advance tax is not payable, then there is no question of deferment. Akash, Hindu undivided family, a resident HUF incurred rupees 22,000 for medical treatment of Mrs. Aarti, Akash wife, who is a person with disability for her maintenance for assessment in 1920. The HUF would be eligible for deduction of an amount equal to 22,000, 52,000, 75,000 or rupees 1,25,000. So you can pause this recording, and if you need more time, then you can replay it again. I am going to discuss correct answer. Here section 80DD of the Income Tax Act says deduction in respect of maintenance, medical treatment of a dependent who is a person with disability, where an assessee being an individual or HUF family who is a resident in India has during the previous year incurred an expenditure for medical treatment, training and rehabilitation of a dependent being a person with disability, or paid or deposited any amount under the scheme framed in this behalf by LIC or by any other insurer, then the assessee shall in accordance being a person with disability, the assessee shall in accordance and subject to the provision of this section be allowed a deduction of sum of rupees 75,000 rupees from his gross total income. So here one time deduction of 75,000 will be allowed if all the conditions are satisfied. So here it's not necessary that the person should incur the expenditure if the amount is paid or deposited as per the scheme, then the assessee shall be allowed a deduction, because it says that the deduction aspect of maintenance including medical treatment of a dependent is done, then the amount of 75,000 up to 75,000 can be claimed. It doesn't say that the actual amount incurred or 75,000 whichever less is allowed. So standard deduction of 75,000 is allowed in this case. Mr. Akash Hindu undivided family, Mrs. Aarti is a member of this family. So individual or HUF can claim this deduction, individual or Hindu undivided family, and in this case deduction of rupees 75,000 will be allowed, although expenditure of only rupees 22,000 has been incurred. Standard deduction is given under section 80DD. So standard deduction of rupees 75,000 will be allowed. A firm pays salary and interest on capital to its resident partner. The salary and interest paid fall within the limit specified under section 40. Which of the following statement is true? Tax has to be deducted under 192 on salary and under 194 on interest. Tax has to be deducted under 192 on salary, but no tax needs to be deducted on interest. No tax has to be deducted salary, but tax has to be deducted under 194 on interest. No tax has to be deducted as source on either salary or interest. So here correct answer is D. No tax has to be deducted as source either salary or interest. So no TDS provisions are applicable if a partnership firm pays the salary or interest to its partner. So friends, like these questions will come in your exam. So if you have any doubt regarding any question, then you can comment on unacademy.com on my profile Satbir Singh, and you can use referral code Satbir, and you can take a 1 month subscription for 499 rupees only. For you have to choose Goal CA exam on unacademy.com/plus website. Here you can learn from your favorite teacher. Dedicated doubt sessions are there. One time subscription you have to pay. With one subscription you can have unlimited access to costing, accounting, auditing, etc. You can have real-time interaction with the teacher. You can ask doubt in live class, download the videos and watch offline. So friends, by a referral code Satbir, you can also get 10% discount on your subscription. Goal C exam you have to choose. I am also taking GST classes, GST revision classes. Timing are from 12 to 1 p.m. in the afternoon, and income tax classes timings are from 6 p.m. to 8 p.m. in the evening. So you can also join those classes. Thank you friends.